Let's start talking on a couple of key macro trends and what that's throwing up at this point in time. Sonal Verma, India economist, Nomura Financial Advisory and Securities, now joins in on this show. Sonal, hi, good to see you in today and wishing you a happy 2015. Wanted to start by asking you about the fiscal deficit math. Now that we have the auction likelihood of, maybe 16,000 crores coming in this fiscal itself, how does it change the maths, and are you more confident of that 4.1% now being met?
Hi, good morning and Happy New Year to you and all your viewers as well. The 16,000 crore honestly, helps, but it doesn't help much. Because the total shortfall on tax revenue front right now is quite significant. The overall tax revenue growth in the first 8 months has been around 6.5% versus the budgeted target of about 20%. So the total shortfall on tax revenue itself is close to 1 lakh crore. Plus we are running behind on the disinvestment target, which is 64,000 crore. So 16,000 crore, marginally helps, but I think we are still staring in at a gap of, a significant gap. And therefore, what it implies is that in the next 2-3 months, the government will need to essentially create more savings or get more revenues in order to get to 4.1.
Sonal, hi, morning. We've seen the 3 increases in excise duty on petrol and diesel. With crude price continuing their big decline, do you think that's one route that the government will keep taking, keep eating the benefit of lower crude prices from here on and further increase excise duty?
They've already taken that route 3 times, and those 3 times cumulatively lead to a revenue of around 55-60,000 crore on an annualized basis. So for the 3 months, they will get a benefit of 16-17,000 crore already from that. There should be some benefit that also needs to flow into consumers, given the decline we are seeing in oil prices. But definitely this is a route that they have, opted for thrice already, so it would not be surprising if this is opted for again.
If there is a slip in the fiscal deficit number of 4.1%, how much do you expect it to slip by?
Well, the starting point is, whether the government is okay with allowing a slip to happen. And I think, most of the comments we've got from Finance Ministry since, I would say in the last 15-20 days, seem to suggest that the government actually is quite clear that they want to meet the 4.1% target for this year. So it doesn't seem really to be a question of whether there will be a slip and how much. So in a sense, we are sort of, instead of doing a bottom-up some analysis on the fiscal finances, really going top-down in terms of if the 4.1% has to be met, then what are the measures that need to be taken. So like I said, based on the revenue numbers so far, expectation of some improvement in revenue going forward, the total shortfall on the deficit front is actually close to 1 lakh crore already, and therefore that is the amount that the government will have to basically save. This saving could come in either by cutting some of the spending which is scheduled. It would come in by postponing some of the spending that is scheduled. It could come in by what some of the news reports are talking about, more dividend payments. It could come in through additional taxes. So some benefit from the excise duty on oil, also the excise on on auto, which has not been extended. That should lead to some gains. So a mix of things will need to be done. Going fast on the disinvestment process now will have to be done in order to ensure that we get to 4.1. Of course, what one ideally wants is that the quality of fiscal consolidation does not suffer as a result. So the productive spending does not get cut. It's really the unproductive spending that gets cut. But right now, the space that is available really is quite limited. So I think the quality of consolidation will suffer as a result.
Okay, Sonal, 2-part question then. Your call on the debt market and the kind of inflows that we saw last year, can that continue? And secondly, your call on the Indian currency, which has remained relatively resilient but is starting to show some signs of sell-off. Though today it's again been quite resilient.
Yeah, right. So our FX and rate strategists are both actually quite bullish on Indian markets. So our call for interest rates is sort of premised on our view on inflation. And I think even before the oil price fall started, we were sort of growing quite confident that inflation will undershoot the 6% target set by the RBI. So we are expecting CPI in the 5.5 range for 2015, notwithstanding the volatility we can see both on either direction in the short term. So with that as a background, we are expecting a 25 basis point rate cut by the RBI, both in April as well as in the June policy. We don't think there will be any cut at the Fed policy. So 7.5 is the repo rate that we are expecting by end of 2015. And based on that view, our expectation is that the 10-year bond yield will gradually fall to about 7.5 over the course of 2015. On the FX front, I think the moderation we are seeing in oil obviously is a big positive for India because every $10 fall in oil is a 0.5% of GDP saving on the current account. So, what is interesting is that India's growth cycle is picking up, and therefore the non-oil, non-gold imports are also seeing an acceleration. But that is largely being offset by the softening we are seeing on the oil price front. So overall, we are expecting a fairly large balance of payment surplus, close to 35-40 billion US dollar, and therefore the fundamental view on currency is positive. Obviously, global factors play a role, and more importantly, the RBI's intervention strategy. And RBI has continued to intervene quite aggressively in the last few months as well, and that therefore becomes the driving force behind the INR moves. Our expectation on INR is for it to be at around 62, 63 in that range by 2015. So overall, actually expecting, our FX team is expecting INR to actually outperform the Asian FX basket.
Okay. Sonal, you're not in the camp that believes that maybe the RBI could act earlier than April? And why is that?
I think, clearly there are two aspects actually when we are looking at inflation. One is what is happening to spot inflation, and spot inflation has surprised on the downside, and our view is it will continue to surprise positively as compared to the RBI's target. But the second aspect is, expectations. And there can be, debates about whether the RBI's household inflation expectations survey throws out a credible number or not. But the fact of the matter is that we are coming from 5-6 years of, close to double-digit inflation. So I think expectations in India have been high. There are reasons to believe that as spot inflation remains low, expectations will also come down. But I think we need to see a prolonged period of low spot inflation for expectations to come down, which is why we don't think there's a need for the RBI to be really, either aggressive or to be ahead of the curve in terms of cutting rates. So by April, I think we'll have a reasonable amount of evidence on how sustainable this inflation is and whether expectations are coming down. And also, the RBI's medium-term inflation target, and which the RBI said the government concurs with, is 4% with a band of plus minus 2%. So the ultimate inflation target is not 6 or 5, it is 4. And second, the growth outlook is getting better. So if we want inflation to continue to moderate when growth cycle is picking up, then the RBI, the space for cutting interest rates is opening up, but we don't think it's going to be very aggressive.
Okay. All right, Sonal, one last question then. Just a quick one-word answer. If you could tell us where you expect the yield to be possibly in the next 3 months and the range.
Yeah, so for the next 2-3 months, our team is expecting the 10-year bond yield to basically be in a range of about 785 to maybe 805. But like I said, the target for end 2015 is 7.5.
Okay. All right, Sonal, we leave it on that note. Thank you very much for joining in and talking to us. So that's the view coming in from Nomura on the macros and the setup at this point in time.